Hey folks, welcome to Verified Investing Alerts. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. Today's date is Friday, March 12th, 2021, and let's get into the action. So we're going to start off with gold today. Gold is falling. The reason gold is falling is the 10-year yield is spiking. So I think that's the bottom line, folks. We know that in the early stages of a yield spike, gold is going to be under pressure. Now, I say early stages because that is not the case for later in the cycle. All right, so right now, yields on the 10-year are 1.602, so we're just back to that 1.6%, and gold is lower. Now, the reason why it'll change and why yields, when they eventually continue up, gold will actually see more upside, and why I'm bullish on gold is because early in the cycle, you have gold going down and yields going up because the economy is getting better. So we're basically returning to pre-COVID yields, right? If you go back to 2019 December, just before China was really getting into the heat of COVID and so forth, yields on the 10-year here in the United States were about 1.8, 1.9%. So just to get back to that level, you have to get back there on the 10-year yield. That's going to continue to put a little bit of pressure here and there on gold. I don't think there's much downside here, though. You're seeing a little downside in gold today, but we're off the lows on the chart. Now, later in the cycle, once the inflation bug hits, gold is going to be the place to be. All right, gold, in my opinion, could get as high as 2,300 by year end if we see that spike in inflation. So compared to where gold is right now, gold trading, just around $1,700 an ounce, that's a lot of potential upside if, and again, I repeat, if the inflation bug starts to really bubble up, which I expect by the third to fourth quarter of 2021. Now, looking at the GLD chart here, you can clearly see why we bounced recently on gold. Look at this channel that we've been stuck in on the GLD. Look at the low end right here. See this lower trend line if you connect this breakout pivot point right there. Boom. And then look, we retraced, and came down. And look, that down sloping trend line meets this pivot support, the lowest of this consolidation, literally pierced it to the penny right there before this most recent bounce on the GLD. Now, we are retracing a little bit of that today, but you still have a long way to go to get back to those lows. I personally think that, again, as yields start to creep up more and more back to the normal levels, you'll see gold actually firm up and then start to outperform as yields push above 2%. All right? So that is something we will be watching for very closely. Now, let's quickly talk about the yield. I think this is really important. So here's a chart of the yield, folks, and I wanted to show this to you because this explains why the yields are having trouble at 1.5, 1.6%, which we're currently at. Now, eventually, we're going to break above this level, but again, we're back to 1.6% today. You can see this was taken yesterday at 1.541%, but you could see pivot here, pivot here, pivot here. So when we broke lower, it was a break of support. Now remember, when support breaks to the downside, right, it becomes resistance on the upside. So as we have traded back up to that, it has been resistance. So a lot of people are like, well, why are yields stalling at 1.5, 1.6% in the short term here? And the answer is very simple. Just go to the charts. It's very, very simple. All right, let's go to the NASDAQ 100. All right, if we take a look at the NASDAQ 100, this is very, very important, guys. We did see a bounce yesterday. I want to show you the moving averages on this because it was a level I gave our members here at In The Money Stocks to look at, and it explains why the market is selling off. Look, Qs are down $4.71 right now, and if you look, there's a necktie. All right, necktie is a technical term here. 20 moving average, 50 moving average coming together. They're converging, creating a cross. That is called a necktie or a bow tie in the technical analysis world. All right, notice how price yesterday kissed that level, pulled back by end of day. What's going on today pre-market? All right, we are seeing the Qs, the NASDAQ 100, pull back. I've gone on record and said that I believe the NASDAQ has put in, back here at this high, a multi-year high. All right, now I still think the S&P has a little bit of upside. I still think the Dow has upside. I still think the Russell has a little bit more upside. But the NASDAQ, being that it's going to get hurt as yields go higher, that is probably, again, that has probably put in a major pivot top, at least for the foreseeable future. All right, so what stocks should we be looking for? Like, where would we want to buy Apple? All right, and I'm going to shock you with some levels here, but you can clearly see that Apple is hovering on support. All right, if you take this trend line here, pivot low, and look, we pierced it, and then we quickly got back above it. All right, we kissed the 200 moving average. Eventually, you're going to take that 200 moving average out on Apple. And this is where you're going, guys. See this pivot top right here? See the gap fill? You want to find two major supports that are close together. That's going to be excessive support. And this is your target, all right? So you're looking at literally a move down on Apple at some point probably in the next year to about $96 a share. All right, there is a buying opportunity for a major swing trade. I think that Apple could be a major, like right at that level, considering the quality, considering where the PE ratio would be at that point. That's something you could tuck away for a longer period of time. I think if it gets there, you're probably talking about yields at 2 or above 2%. The question is, how much above 2% will we go? The Fed, remember, and this is the tricky thing, and this is the final thing I'll leave you guys with, but the Fed can't really let yields get too out of control in the near term over the next couple years. The reason is because we have to service our debt. Our debt is massive, $30 trillion and growing by the trillions now. All right, we're going to have an infrastructure package soon. You're going to see taxes going up, which, by the way, will be one of the catalysts for pushing Apple down to that level. But the bottom line is yields, if they go up too much, this country will go bankrupt. All right, we cannot service our debt at those levels. So the Fed will throw everything, including the kitchen sink, at the yields to keep them down. I'd say probably around 2%. 2%, I would guess that they don't want them to go above. Eventually, they will fail on that, but that'll be a long way away. But in the next couple years, probably about 2% is where they want. Even if inflation gets out of control, they're going to try to keep those under control. All right, bottom line is here, guys. Come to inthemoneystocks.com. Check out Verified Investing. You can see the track record, all right, on the page for Verified Investing, which you can find under my name on the top of the website. It's drop down Verified Investing Alerts. You can see the track record. It's a verified track record, 318.52% this year already. Last year, we banged out a monstrous 1,500+% in gains, and it was just a tremendous year. This year's already off to a great start. The volatility makes this a great swing trading market. Members are making money hand over fist. Yesterday, we sold PayPal for 11.5% gain. The day before that, we sold SQ for over 10%. We sold INSG for a big gain. All right, it's the profits are here. We short the market when it's going to go down. We buy the market when it's going to go up. Easy swing trades to follow. You get text and email alerts if you want them. And again, all the information is there. Entry price, exit price, you name it, it is there. Come join me at inthemoneystocks.com. Look for Verified Investing Alerts. Take care.